Hey guys, good afternoon. It's Angelo, Christian Financial. Thank you so much for our podcast, Real Estate Insider. We've shot over 720 videos in the last 5 years. It's where America goes for funding. We're a nationwide commercial and residential lender. Call or text us at 832-431-6331. We actually talk to our customers. We're a real live mortgage lender here to help and serve you in America, all over the country, all 50 states, commercial and residential lending. Today, we're actually bringing a very important topic to you guys out there. If you're married, how does your spouse actually affect you when you're trying to get a mortgage approval? And this video was brought to you by Michael Burdone out of Tampa, Florida. Just recently purchased a property with us, and it was just him on the loan. And he was married but didn't want to put his wife on the loan, and he asked us to make a video about this. Just closed on his beautiful home in Tampa. So this one's for you, Larry. And one of the biggest things that I will say is that depending on the type of loan that you're getting, depending on what state that you're buying in, all these things matter if you're married. So there's going to be a link to this video too. One of the important things I put up here on the board is community property. So in the YouTube description, you can download the states that are actually community property states in the United States of America. There's 13 states, and you can download that to see all the different states. States like, for example, Wisconsin, Texas, California, Louisiana. These are community property states, okay? And we're going to talk about what community property state actually means. Not every state in America is community property, and it also depends on the type of loan that you're getting. So the bottom line is that if you're trying to get a mortgage approval and you are married, it can affect you, it can hurt you. I see it every single day where someone's trying to get a home loan in a community property state, or maybe not even in a community property state, and maybe one of the spouses had a nasty divorce. Hey, are you someone out there that maybe you got denied from another lender? Maybe they improperly looked at your loan the wrong way, they denied you. Give us a call. We might be able to help you and turn that thing around. We can come up with a different strategy. There's a lot of laws and loopholes and ways we can help you to get your mortgage approved. But the bottom line is that if you are married and one of the spouses has a lot of debt, or I've seen some couples where they are strategically trying to accumulate real estate assets and they hide debt in one of the spouse's names so the other spouse can accumulate real estate assets. Hey, I've seen it all, man. But basically the biggest thing is to know what the rules are, the laws, the requirements for the different programs, to educate you before you apply for your home loan to make sure that you're successful. So the bottom line is it can and will affect you if you are married. But we're going to talk about the different requirements on that. So the biggest thing to know, and download that list of the community property states, and even if it's not community property, but on government loans, and it's in a community property state, let's say that, and I use an example here, the husband, I'm Johnny, and I want to buy a home in Texas, and I want to do a VA loan, or I want to do an FHA. When I'm talking about a government loan, I'm talking about FHA, VA, USDA. That's a government-backed loan. If you're in a community property state, the government, the law says that even though Johnny wants to buy the house by himself, Johnny applies for the loan. In this example, Johnny has a 750 credit score. He makes $50,000 a year. He only has $400 a month in debt. He's a veteran. And he says, I would like to apply for a home loan, Angelo. Can you approve me? Now, I'm going to say, sure, of course we can help you. Well, let's do your application. But he says, wait a second, I don't want to put my wife on the loan. Okay, so my wife, and I'm going to ask him, well, hey, Johnny, you're in Texas. We have to put your wife, we have to pull her credit. The spouse in a community property state doesn't have to go on the loan, and her credit score is not needed. Okay, doesn't have to go on the loan. Her credit score is not needed. But her debt has to be added into your debt ratio. This is a very, very important topic, okay? I know you don't want to put your wife on the loan, Johnny, and you don't have to put her on the loan. She does have to go on the deed and the title. Must go on deed and title. Does not have to go on the loan. Okay? But her debt has to be added into your debt ratio. What does that mean? If she's paying $2,000 a month in debt, and you say, Angelo, I would like to buy a home for $300,000, sir. I saw a beautiful new home in a brand new subdivision by D.R. Horton. And I'm going to say, well, we got to look at that and see if you can qualify. But I don't want to put my wife on a loan. My wife, you know, she has a 550 FICO. Okay? You can't get a mortgage with a 550 credit score right now, unless it's a hard money loan, and you don't, and you can put 35% down. So they're trying not to put the wife on the loan because she has bad credit. She has a lot of debt. We don't have to use her credit score. We don't have to put her on the loan. She has to go on the deed and the title per the law, and we have to put this debt into his debt ratio. So let's just take a look at that and see what we're talking about here. So and you can save this or come back and watch this video and see all this. I have to erase this though to show you what I'm talking about. So this is the thing. You want a $300,000 house, and a $300,000 home is going to be about $2,100 a month for the payment. Okay? So the bottom line, we have to see if this can even work. Okay, Johnny's making $4,300 a month. The wife's making $3,000 a month. Okay, that's $7,300 a month in income. The house is going to cost $2,100. She has $2,000 in debt. He has $400. So right here you have $4,500 a month in debt. And here we have $7,300 a month in income. Remember my video that we shot on debt to income ratio? How do we calculate debt to income ratio? Debt divided by the income. So we have $4,500 divided by $7,300. And we know for an FHA loan, if you watch my videos, the highest debt ratio you can have is 55%. So the question is, in this example, if you have $4,500 a month in outflow and you're earning $7,300 a month in income, you have a 62% debt ratio. So the debt ratio equals 62%. I promise you, if you went anywhere, any lender, mortgage lender in the United States, they probably deny your loan if they saw this scenario. I could figure out how to get you approved and closed. I can do it. So there's a lot of solutions here on how we can figure this out. But the most important thing right now that you can understand is that if your spouse has debt and you're doing a government loan and you're in a community property state and you don't want to put your spouse on the loan, you still have to put her debts onto the debt to income ratio. And that can and will affect you to get approved for your home loan. Okay? So it's very, very important. Now, one of the things that's really cool about this, another solution that we could do, I didn't say conventional loans, you had to add your spouse's debt to the debt to income ratio. I just said government loans. So we could do a conventional loan. You see? I can do the loan just for Johnny, just on his income alone. See? That's a very smart idea that we can do. Because there's a trick, there's a strategy. And that strategy is I can do a conventional loan for you. Conventional loan, the law says I don't have to add the spouse's debt, just government loans. Okay? So in a conventional loan, if Johnny makes $4,300 a month and he only has $400 a month in debt, and the new home is $2,100, that's $2,500 in debt. Okay? So $2,500 in debt divided by your income, because we can't use the wife's income now. That's one of the things. If she's not going on the loan, we can't use her income. So in this example, your debt ratio now is 48%. And with conventional, when you're putting 20% down, you can go up to a 50% debt ratio with conventional. The important thing to realize is that with our company, there's always a strategy, there's always a way that we're figuring out how to get you approved, how to close. And that's one of the biggest things that's different about us, how we're different, is a lot of lenders, when they talk to you, if you don't fit that perfect mold, 800 credit score, 20% down, $500,000 house, they don't want to deal with you. If you have issues with your credit, you have a spouse that has a lot of debt or low credit score. We approved a veteran recently that the husband got denied by another lender because he had a 700 credit score, she had a 550 credit score, and they couldn't use her income because it was child support income in her name. We boosted up her credit score to 670, added her to the loan, and closed the loan for them. That's how we're different, guys. We're gonna try and figure out how to get your loan approved, how to restructure it to get you qualified. It's a very, very important thing because it's very discouraging, very disheartening if you're trying to get a loan and you get rejected or denied. Because I believe that every hardworking person that can pay rent can certainly deserve to own a home. So it's very, very important that you work with the right type of lender that's gonna go the extra mile, that's gonna put in the effort to get you approved for the loan. So the biggest thing in this example that I want you to take away is that if your spouse does have debt, that we have to add it to the debt ratio. It's a community property state if you're doing a government loan. If you're in a non-community property state, like for example in Florida, like I did for my other client, and your wife's not going on the loan, then her debt doesn't even matter, okay? So, but if your wife is going on the loan, we do have to use her income, we do have to use her debt, okay? You can't use someone's income without putting them on the loan. I know a lot of people, they call and say, hey, can I use my wife's income as total household income? You can't use that income if she's not going on the loan. And to go on the loan, she has to have a qualifying credit score to go on the loan. So it's very important that you're aware of that. But if you are in a non-community property state, then if you don't put your wife on the loan and you're doing a government loan, then you don't have to include her debt. So that's a big distinction, because I don't want you to feel down and out because, you know, maybe you got married and you didn't realize that your spouse, you know, has all this debt. Now you can't get approved for the loan. It's not her fault. You don't have to blame her, be upset with them or him or her or whoever. It's just the way that lending works, and you have to strategize around this to figure out how to, you know, approve you. And so that's what we do here. We figure out all day long how to help people to get funding for their mortgage loan. So call or text our office. We'd love to hear from you, 832-431-6331. If we can get you any type of mortgage funding, please reach out to us. We want to help you in any capacity that we can to get you pre-approved for your home loan. Call or text us. There's also a link down below in the YouTube description. You can click there to get signed up to get pre-approved. Also, that community property list will be there too. You can check out all the states in the United States that are actually community property states. And if we can help you with any commercial or residential loan, please reach out to us. Call or text us at 832-431-6331. Take care. Peace out. Check out my next video, everybody. Thank you.